Major changes are being made inside the banking system quietly, and most people will not notice them until the moment they need their money. That is usually how large systems change. They do not always announce themselves with one dramatic event. They change through rules, through compliance procedures, through legal language, through monitoring systems, and through the incentives of banks, regulators, and governments. By the time ordinary people feel the effect, the system has already adjusted around them. I do not look at this as a conspiracy. I look at it as a machine. When you understand the machine, you do not need to be afraid of it. But if you do not understand it, you can be trapped by it without doing anything wrong. That is what is happening now. People still think of a bank account as a simple thing. You deposit money, the bank holds it, you withdraw it when you need it. That was the mental model for a long time. But the modern banking system is no longer just a vault. It is a balance sheet, a legal contract, a compliance network, a reporting system, and, in times of stress, sometimes a control mechanism. That distinction matters if you are wealthy, retired, internationally exposed, holding large deposits, moving money across borders, using cash, holding crypto, receiving unusual transfers, or simply keeping funds in accounts you do not touch often. The rules around your money may not work the way you assume they work, and that is why many sophisticated people are worried. Not because they think the banking system collapses tomorrow, not because they believe every government is coming for their money. They are worried because the rules are changing in a direction that gives institutions more power, more discretion, more surveillance, and more control over when money can move. The most important principle is simple. Your money is only truly useful if you can access it when you need it. A number on a bank screen is not the same as liquidity. A deposit balance is not the same as freedom of movement. A legally owned asset is not the same as an asset that can be moved without delay, restriction, or review. That is the problem I want you to understand. The first major change is the shift from bailouts to bail-ins. Most people still carry the memory of the old model. If a bank got into trouble, the government would step in, depositors would be protected, the institution would be stabilized. Taxpayers would take the pain indirectly, usually through government spending, debt, and inflation. That was the pattern for a long time. But after the 2008 financial crisis, regulators looked at the cost of rescuing large banks and said, in effect, this system cannot keep working this way forever. Governments did not want to be in the position of using public money every time a major financial institution made bad decisions or suffered severe losses. So the logic changed. Instead of a bailout from the outside, the system developed the concept of a bail-in from the inside. A bail-in means that when a bank becomes insolvent or faces extreme stress, losses can be absorbed by parties connected to the bank. First, shareholders take the hit, then debt and bondholders. And eventually, in some circumstances, large uninsured depositors can become part of that loss-absorbing structure. That sounds technical, but the practical meaning is very direct. Money above the insured limit is not protected the same way most people think it is protected. In the United States, deposit insurance is generally limited to $250,000 in the European Union. The common protection level is around €100,000 in the United Kingdom. It is £85,000 in Canada. It is 100,000 Canadian dollars. Everything above those limits is not sitting in a separate box with your name on it. It is a claim against the bank. That is how banking works. The bank uses deposits as part of its funding structure. You are not storing physical cash in a vault. You are lending money to an institution that promises to repay you on demand, subject to the rules of the system in normal times. That distinction does not matter in a crisis. It matters a great deal. Wealthy people understand this because they have to. They know that having too much cash concentrated in one institution can create a risk that has nothing to do with the stock market, nothing to do with their own spending habits, and nothing to do with whether they paid their taxes correctly. It is institutional risk. The reason this worries people is not because bail-ins happen every day. They do not. The reason it matters is that the legal framework exists. And once a framework exists, it can be used under stress. A good decision maker does not ask, will this happen tomorrow? A good decision maker asks, if the system is stressed, what are the rules, who has power, who is protected, and where am I in the loss chain? If you have deposits above the insured limits, you should know the answer to that question. The second major change is dormant account treatment. This one surprises people because it has nothing to do with a bank failure. It has nothing to do with whether the bank is healthy. It has nothing to do with whether you committed a crime. It has to do with inactivity. In many countries, if a bank account or financial asset sits untouched for long enough, it can be legally classified as dormant. Once that happens, unclaimed property laws can allow the funds to be transferred to the state. The money may still be reclaimable later, but the process can become slow, bureaucratic, and frustrating. For most ordinary people, this sounds unlikely. They assume they would never forget about an account. But families are complicated. People age, they move, they change phone numbers. They lose paperwork, they pass away. Heirs do not always know where accounts are held. Small investment balances and savings accounts can sit untouched because nobody is watching them carefully. And the important change is that the dormancy periods in some places are becoming shorter or broader. In some jurisdictions, accounts may be considered dormant after only a few years of inactivity. Australia shortened dormancy periods for many financial assets from 7 years down to 3 years. The United Kingdom expanded its dormant asset system beyond bank accounts into other assets, including investment and insurance balances. In the European Union, policymakers have discussed harmonizing dormancy rules across member states, which could pull different systems toward a lower shared threshold. These changes are not theoretical. They are part of a broader direction in which idle assets are less likely to sit untouched forever and more likely to be pulled into state-supervised systems. Now compare that with jurisdictions that treat asset ownership differently. In Switzerland, banks have a long and formal process for dealing with dormant assets, and the search period can be measured in decades. In Liechtenstein, institutions have strong obligations around maintaining client assets. Monaco also has a much longer window than the short 3 to 5 year timeframes you may see in parts of the United States. The point is not that every person needs a Swiss bank account. The point is that rules differ dramatically across systems. A system that treats dormancy after 3 years is not the same as a system that continues trying to locate you or your heirs for decades. A system that prioritizes administrative efficiency is not the same as a system that prioritizes long-term asset ownership. If you are building financial resilience, you cannot just ask, where is the highest interest rate? You have to ask, what is the legal culture around ownership, privacy, inheritance, and access? The third major change is civil asset forfeiture. Most people believe the government can only take your assets after proving that you committed a crime. That belief is not always correct. In many developed countries, there are legal mechanisms that allow authorities to freeze or seize assets without a criminal conviction. In the United States, this is called civil asset forfeiture. In the United Kingdom, authorities can use unexplained wealth orders. Australia and Canada have similar systems connected to proceeds of crime laws. These laws were originally designed for serious problems: organized crime, corruption, money laundering, and illicit wealth. That purpose is real, but the risk comes from the threshold for action. Assets can be frozen long before a case is fully resolved. The process can begin based on suspicion, patterns, documentation gaps, or unexplained flows. When that happens, the money may still legally belong to you, but functionally it is not available to you. This is one of the most important distinctions in finance. Ownership and access are not the same thing. You can own an account and still be unable to use it. You can be innocent and still spend months or years proving that your funds are clean. You can win in the end and still lose time, legal costs, peace of mind, and liquidity. That is why serious people think about jurisdiction. Every strong banking center has legal processes for freezing assets when there is a valid order. No legitimate jurisdiction is a place to hide from real law enforcement. But some countries require a higher standard, a more rigorous process, stronger domestic court involvement, or more documented evidence before they act. That difference matters. The goal is not to escape the law. The goal is to avoid being trapped by weak process, aggressive enforcement, or frivolous claims. When I think about asset protection, I do not think in emotional terms. I think in layers. One layer is where the asset sits. Another layer is what legal system governs it. Another layer is what documentation exists. Another layer is how easy or difficult it is for a third party to freeze it. If you have only one bank in one country under one legal system with all your liquid funds concentrated there, then you have one point of failure. A resilient system does not depend on one point of failure. The fourth major change is the growing relevance of capital controls. Many people in developed countries believe capital controls are something that happens somewhere else. They imagine them in unstable economies, in countries with weak institutions, high inflation, political chaos, or collapsing currencies. That is a dangerous assumption. Capital controls can appear in developed economies when stress is severe enough. During the Cyprus banking crisis in 2013, withdrawal limits were imposed and international transfers were restricted. During the Greek debt crisis, ATM withdrawals were capped. After Iceland's banking collapse, strict capital controls lasted for years. These were not imaginary examples. They happened in real countries to real people with real bank accounts. When capital controls are imposed, your money may still be in the bank, your balance may still appear on the screen, but the system changes what you can do with it. Withdrawals may be limited, international transfers may be blocked, foreign currency conversion may be restricted, businesses may struggle to pay suppliers, families may not be able to move funds to relatives abroad, investors may be locked into a currency or banking system at precisely the moment they most want flexibility. This is why timing matters. The time to create banking optionality is before capital controls exist. Not after. Once controls are in place, the door is often already closing. You cannot easily move money out of a system after the system has decided money must stay inside. This is why many people from countries with capital controls or currency instability think very differently from Americans or Western Europeans. People from Argentina, China, South Africa, India, and other places where restrictions or currency pressure are more familiar often understand instinctively that banking in only one country is a risk. They do not see foreign banking as exotic, they see it as basic risk management. Again, the principle is simple. You do not diversify because you know exactly what will happen. You diversify because you do not know exactly what will happen. The fifth major change is the rise of investment and asset restrictions. Governments increasingly shape what individuals can hold, how they can hold it, and how it must be reported. This shows up in different ways. In the United States, foreign mutual funds can create complicated tax consequences for investors. In the United Kingdom, policymakers have discussed caps or restrictions on certain stablecoin exposures around the world. Regulators are paying closer attention to cryptocurrency holdings, foreign currency accounts, and gold transactions through reporting rules and compliance requirements. Each rule has its justification: financial stability, consumer protection, anti-money laundering, enforcement, tax compliance. Those justifications are not meaningless. They often come from real risks, but from the perspective of the individual, the effect can still be the same: less freedom to allocate capital as you choose. The more a government worries about financial stability, capital flight, tax leakage, or currency weakness, the more likely it is to influence what citizens can do with their own funds. That is a basic cause and effect relationship. A government with rising debt needs funding. A government with a weakening currency wants capital to stay inside the system. A government worried about speculation may restrict certain assets. A government worried about tax enforcement may expand reporting. You do not need to be cynical to see the incentives. You only need to look at the system as a system. When rules become more restrictive, investors who planned ahead have more choices. Investors who did not plan ahead have fewer choices. That is why wealthy people think about what they are allowed to own before the rules change, not after. The sixth major change is currency debasement and the possibility of central bank digital currencies. Currency debasement is not a dramatic event. It is usually a slow process. It happens when the money supply expands faster than real economic productivity, and the purchasing power of each unit of currency declines. If inflation is higher than the interest you earn on deposits, your bank balance may look stable, but your real wealth is shrinking. This is why cash can feel safe while quietly becoming dangerous. You see the same number on the screen, but the number buys less. That is a form of loss. It is just a loss that happens silently at the same time. Central banks around the world have explored central bank digital currencies, or CBDCs. These would be digital national currencies issued directly or indirectly through the central banking system. The important thing is not to pretend we know exactly how they will be used. We do not. Different countries are exploring different models. Some may be harmless, some may be useful, some may never be adopted broadly, but the concern is about the tools they could make possible: programmable money, spending restrictions, negative interest rates that are easier to impose, targeted stimulus, demographic-based controls, more direct monitoring of how money moves. Those possibilities are why many wealthy people begin diversifying before the system is fully built. They do not wait for certainty. In markets and policy, waiting for certainty usually means waiting until the price of protection has already gone up or the door has already narrowed. The Dalio principle here is that cash is not just cash. Cash is a promise inside a system. If the system changes, the promise changes. If the currency weakens, the purchasing power of the promise changes. If the legal framework becomes more programmable or restrictive, the freedom attached to the promise changes. So a good financial system should not depend entirely on one currency, one bank, one country, or one policy regime staying friendly forever. The seventh major change is tax authority reach. Every developed country has mechanisms that allow tax agencies to freeze accounts, usually for unpaid taxes or serious tax disputes. That is not new. What is changing is the reach, speed, and coordination of the systems. Through FATCA common reporting standards and information exchange agreements, tax authorities can gather and share more information about accounts across borders. A person may think an overseas account sits outside the view of domestic authorities, but in many cases that is no longer true. To be clear, this is not an argument for avoiding taxes. People who build durable wealth should comply with tax laws, file properly, report what must be reported, and keep clean records. But compliance does not eliminate every concern. A person can be paying taxes correctly and still worry about aggressive or mistaken action by tax authorities. A business owner can be under review. A retiree can have documentation gaps. A person with international accounts can face questions that take time to resolve. During that time, accounts may be frozen or restricted. The risk is not only whether you win the dispute, the risk is whether you lose access while the dispute is happening. Some jurisdictions require domestic court proceedings before enforcing certain foreign claims. Others require specific treaty provisions and documented evidence. Others may move faster once a foreign legal order is presented. This is why jurisdictional quality matters. A good system should respect legitimate law enforcement while also protecting people from overreach, weak claims, and administrative aggression. The more international your life becomes, the more important it is to understand that the legal environment around your bank account is part of the asset. It is not separate from the asset. The eighth major change is transaction monitoring. Every bank today monitors account activity. That is a legal obligation under anti-money laundering rules. In the United States, suspicious activity reports are part of that system. Canada reports through FinTrack. Australia uses AUSTRAC. The United Kingdom and the European Union have their own frameworks. Many people think the only thing that matters is a formal threshold, like $10,000. That is not true. Transactions below formal reporting thresholds can still trigger monitoring. A transfer can be flagged because it is unusual for the account. A wire can be held because the destination is unfamiliar. A cash withdrawal can trigger questions because it deviates from historical behavior. A pattern can look risky even when every individual transaction is legal. What is changing is the speed and sophistication of the monitoring. Banks are moving toward behavioral analysis, AI-driven assessments, and broader information sharing. They do not simply look at one transaction in isolation. They look at patterns, they compare activity to your history, they compare you to similar clients. They look at geography, counterparties, timing, frequency, and category. That is powerful. It is also dangerous when the system does not understand context. A large transfer may be innocent. A sudden withdrawal may have a legitimate purpose. A foreign wire may be routine for an international family. A crypto-related transaction may be legal, but compliance systems are built to reduce institutional risk, not to understand your life story. That means accounts can be temporarily frozen while a review occurs. In some cases, reviews can take much longer than expected. People who need access to meaningful liquidity cannot build their lives around the hope that a compliance department moves quickly. The banking system is becoming more data-driven. That does not automatically make it more fair. It makes it more efficient at seeing patterns. But a pattern is not always proof of wrongdoing. That is why documentation, relationship banking, and having accounts in institutions that understand your profile matter so much. If you regularly send large international transfers, you should not bank only with an institution that treats every international transfer as abnormal. If you hold significant assets, you should not depend entirely on a bank that is designed for small retail balances and simple domestic activity. Fit matters. A bank should match the life you actually live. The next major change is de-risking. This is when a bank closes or restricts an account not necessarily because the client did something wrong, but because the bank decides the client profile creates too much risk, too much cost, too much compliance burden, or too much uncertainty. Banks call this risk management. Clients experience it as rejection. This can happen to people and businesses connected to cryptocurrency. It can happen to politically exposed persons. It can happen to clients who send large international transfers. It can happen to people connected to certain countries. It can happen to businesses that are legal but considered high compliance. It can even happen to ordinary clients whose activity simply does not fit the bank. As preferred model, the bank may not want to investigate deeply. It may not want to understand the client. It may decide that closing the account is cheaper and safer than keeping it open. From the bank's point of view, that may be rational. From the client's point of view, it can be devastating. Imagine running a business and suddenly losing your operating account. Imagine having payroll due and being told your banking relationship is ending. Imagine being a retiree with international family transfers and finding out your bank no longer wants your account. Again, this is not about guilt, it is about incentives. Banks are punished heavily for compliance failures. They are not usually punished heavily for closing an account that might have been fine. So the incentive is to avoid risk, sometimes bluntly. The protection is not to argue with that incentive after it has already hurt you. The protection is to build redundancy before you need it. More than one bank, more than one jurisdiction when appropriate. Banks that understand your profile, clear documentation, a relationship with real human bankers, when the size of your assets justifies it, a system with backups. That is how resilient people think. The final major change is the restriction of physical cash. This is especially visible in parts of Europe, where countries have rolled out limits on cash payments or made it increasingly difficult to use cash for larger transactions. France, Spain, Greece, and the Netherlands have all moved in directions that restrict or discourage cash use in different ways. But the issue is broader than law, even where cash is technically legal. Banks and merchant service providers can make it hard to use. Businesses may refuse it. Banks may ask more questions, large withdrawals may trigger compliance reviews, deposits may be scrutinized, merchant systems may push people into digital channels. Physical cash gives people a kind of freedom. It is private, it settles immediately. It does not require approval from an app, a bank server, a card network, or a payment processor. That is why many governments and institutions dislike it. It is also why many people value it. The move away from cash is usually presented as convenience, safety, efficiency, and anti-crime policy. Those benefits are real in some situations. But the cost is that financial life becomes more dependent on permission systems. If every payment is digital, every payment can be tracked. If every payment goes through an intermediary, every payment can be blocked. If cash disappears, the individual's ability to transact outside the digital system declines. That is not a small thing. It changes the balance of power between the person and the system. The countries that still respect asset ownership and financial freedom tend to be the same traditional banking hubs that understand why wealthy people need flexibility, privacy within the law, and the ability to move capital responsibly. This does not mean everyone should run from their home country. It means everyone should understand the direction of travel. When I put all of these changes together, I see one big pattern: the banking system is becoming more controlled, more monitored, more rules-based, more automated, and more integrated with government reporting and enforcement. Some of that is necessary, some of it prevents crime, some of it protects consumers, some of it reduces systemic risk. But every system creates trade-offs. A system that gives regulators more power gives individuals less frictionless control. A system that gives banks more discretion gives clients more uncertainty. A system that monitors more behavior creates more false positives. A system that reduces taxpayer bailouts may expose large depositors to more risk. A system that discourages cash makes money more programmable and less private. The mistake most people make is thinking about each change separately. They hear about bail-ins and forget it. They hear about dormant accounts and think it will not apply to them. They hear about civil forfeiture and assume it only catches criminals. They hear about capital controls and assume they happen only in unstable countries. They hear about CBDCs and treat them as futuristic. They hear about tax authority information sharing and think compliance is enough. They hear about AI transaction monitoring and assume the bank will understand context. They hear about de-risking and assume good clients are safe. They hear about cash restrictions and assume convenience is all that matters. But when you connect the dots, you see the system moving in one direction: more control, more monitoring, more institutional discretion, less assumption that you can access and move money freely at all times. That is the point. And once you see that point, the response is not panic. The response is design. You design a better personal banking system. The first principle is to stay within insurance limits where practical. If you hold deposits above insured limits, understand what risk you are taking, use multiple institutions if needed, understand how the insurance rules apply by account type, ownership structure, and institution. Do not assume a single large deposit is automatically safe because the bank has a respected name. The second principle is to avoid dormancy. Keep a list of every account and asset you own, log into accounts regularly. Make small legitimate movements when appropriate. Keep beneficiaries updated. Make sure your heirs or trusted representatives know where accounts exist. Do not allow money to disappear into forgotten corners of the system. The third principle is documentation. If money moves, create a record. Why did it move? Where did it come from? Where did it go? Who was involved? What contract, invoice, inheritance document, sale record? Tax filing or transfer confirmation explains it in a world of automated suspicion. Documentation is your defense. The fourth principle is jurisdictional diversification. You do not need to be extreme. You do not need to make life complicated for no reason. But if you have meaningful assets, international exposure, political risk, currency risk, or concentrated deposits, it is rational to consider whether part of your banking life should sit in a strong, stable jurisdiction that respects ownership and has a high-quality legal system. The fifth principle is liquidity redundancy. Have more than one way to access money, more than one bank, more than one payment method, more than one currency, if your circumstances justify it, more than one path to transfer funds in an emergency systems. Fail at the worst times. A resilient person does not rely on one door. The sixth principle is relationship. A purely digital banking relationship can be efficient, but it can also be fragile. When a compliance issue appears, a real relationship with a banker or institution that understands you can make a difference. Not always, but often enough to matter. The seventh principle is fit. Do not force a complex financial life into a bank that wants simple clients. If your profile involves large balances, international transfers, business activity, crypto exposure, foreign assets, or complex estate planning, choose institutions accustomed to those realities. The eighth principle is legal and tax compliance. Diversification is not hiding. Asset protection is not evasion. International banking is not a substitute for reporting. The cleanest money is the money you can explain. If you build a global banking structure, build it properly. The ninth principle is to preserve optionality before you need it. This is one of the most important principles in investing in life. Optionality is cheapest when nobody thinks it is necessary. It becomes expensive, restricted, or unavailable during a crisis. You do not buy insurance after the house is burning. You do not build a second banking relationship after your first account is frozen. You do not move money abroad after capital controls are announced. You do not create documentation after you are under review. You do it before. That is what prudent people do. The purpose of understanding these rules is not to become fearful. Fear makes people reactive. Understanding makes people prepared. When I look at the banking system, I see a machine built from incentives. Banks want to reduce regulatory risk. Governments want tax visibility, financial stability, and control during stress. Regulators want to prevent crime and avoid another crisis. Technology makes monitoring easier. Debt and currency pressures increase the temptation for more control. Consumers want safety, convenience, yield, and access. All of these incentives collide inside your bank account. That is why the rules matter. If you assume the system exists only to serve you, you will misunderstand it. The system exists to protect itself first. Your job is to protect yourself intelligently inside it. That means you should know the insured limits. You should know what happens to uninsured deposits. You should know when an account can be treated as dormant. You should know how civil forfeiture works. You should know what capital controls can do. You should know how asset restrictions can limit choices. You should know how inflation and debasement erode cash. You should know what CBDCs could make possible. You should know how tax authorities share information. You should know that transactions below formal thresholds can still be monitored. You should know that banks can risk clients who do nothing illegal. You should know that cash freedom is being reduced in many places. None of this means you should distrust every institution. It means you should stop being naive about institutions. There is a big difference. The people who get hurt in transitions are often not the people who did something wrong. They are the people who assumed the old rules still applied after the system changed. They assumed deposits were always fully safe. They assumed inactivity was harmless. They assumed innocent money could not be frozen. They assumed developed countries would never impose capital controls. They assumed their bank would always want them as a customer. They assumed cash would always be usable. They assumed privacy would remain the default. Assumptions are expensive, principles are cheaper. The principle is this: build a banking structure that can survive stress. Do not concentrate all liquidity in one place. Do not ignore legal thresholds. Do not let accounts go dormant. Do not move large sums without records. Do not wait for a crisis to build international optionality. Do not confuse convenience with safety. Do not confuse a bank balance with control. And do not confuse compliance with resilience. You can be compliant and still fragile. You can be honest and still frozen. You can be wealthy and still illiquid. You can be safe on paper and trapped in practice. That is why this matters. The banking changes being made now are not all bad, and they are not all new. Some have existed for years, some are being strengthened, some are becoming more automated, some are spreading across countries, some are only beginning to take shape. But together they tell you something important. The world is moving toward a financial system where access is conditional, monitoring is constant, and mobility is more valuable than most people realize. If you understand that early, you can prepare calmly. If you understand it late, you may experience it as a shock. I would rather prepare calmly. That is how I think about risk. Not as something to fear, as something to map. Not as something to obsess over, as something to design around. When you design around risk, you do not need perfect predictions. You only need to reduce the consequences of being wrong. That is the real lesson. You do not know which bank will have trouble. You do not know which country will impose controls. You do not know which compliance review will take longer than expected. You do not know which policy will become more restrictive. You do not know how digital currencies will be used. You do not know when cash restrictions will become more common. But you do know that systems under pressure tend to protect themselves. And when systems protect themselves, individuals need options. Build those options before you need them. That is the rational move. That is the principled move. And for many people, it may be the difference between having money in theory and having access to money in reality. So look at your banking life. Honestly, where is your liquidity? How much is uninsured? How many institutions do you depend on? How many jurisdictions do you depend on? How strong is your documentation? Would your heirs know where everything is? Could you move funds if your home country imposed restrictions? Would your bank understand your transaction patterns? Do you have backup access if one account is frozen, closed, or delayed? These are not paranoid questions. They are system questions. And in a changing system, the person who asks better questions gets better outcomes. The banking rules are changing. The monitoring is increasing. The discretion of institutions is widening. The use of cash is narrowing. The pressure on currencies is not going away. And the value of optionality is rising. You do not need to panic. You need to think clearly. You need to organize. You need to document. You need to diversify intelligently. You need to understand that the safest looking place is not always the most resilient place. And above all, you need to remember that the purpose of money is not just to be counted. The purpose of money is to be usable when life demands it. If your money can be frozen, restricted, monitored into delays, trapped by capital controls, lost to dormancy, eroded by inflation, or made inaccessible by a bank that decides your profile is too much trouble, then you do not just have a money problem, you have a system design problem. Fix the design before the stress arrives. That is how you protect yourself. That is how you protect your family. And that is how you stay free in a financial world that is becoming more controlled every year.